Hey everyone, Noah Zerby here. This is one of a series of short videos introducing key concepts and theories in international political economy. In this video, we're going to focus on the immediate post-World War II economy, and in particular the idea of Keynesianism that emerges there. So let's get started. So in an earlier video, we considered how the United States and other countries were finally able to escape the Great Depression. Specifically, we considered both the New Deal policies implemented by the Roosevelt administration and the impact of World War II on creating new economic activity. But there's a theoretical approach that helps us understand how all of this worked. Writing during the height of the Great Depression, British economist John Maynard Keynes argued that the Great Depression had been caused by a sharp decline in consumer demand and generated by a collapse in employment. This approach was referred to as Keynesianism, and it was the dominant approach for understanding how the global political economy worked from the Great Depression really into the 1970s. Keynesianism's overriding focus is on employment. According to Keynes, classical economic theory prior to the Great Depression could not understand the emergence of the Great Depression. That theory argued that the Depression should not have occurred because rising unemployment should have automatically been offset by declining wages. That is, as unemployment increased, wages or the price of labor should have decreased to the point at which demand for labor picked up again. But Keynes argued that the Depression was not the result of normal business cycles, but instead the result of irrational economic behavior. Fearing they might lose their jobs, workers cut back on their discretionary purchases. As they did this, consumer demand declined, causing factories to reduce their production and lay off workers. Workers, who now saw their friends, neighbors, and co-workers losing their jobs, cut back still further on their discretionary expenditures, thus exacerbating the layoffs and so on. A vicious cycle of expectations and fear led to a further decline and further deepening of the economic downturn. And remember that in the absence of a social safety net, these fears and reactions were exacerbated because the cost of losing your job was potentially starvation. The solution, Keynes argued, was government intervention. Specifically, Keynes argued that the government should do three things to counter the cycle and reassure consumers, whom Keynes believed were the driving force for the economy. First, Keynes believed that the government should have as its primary economic goal the maintenance of full employment and economic growth. By full employment, Keynes meant that everyone who wanted a job should have one. During a depression, Keynes believed that it was imperative for the government to provide employment through public works programs like the Works Progress Administration or other initiatives. Second, Keynes supported strong social safety net programs like unemployment insurance and Social Security. As with ensuring full employment, this was not simply a moral question for Keynes. Rather, by guaranteeing employment and providing a social safety net, Keynes believed that the tendency for consumers to cut spending in the face of a possible economic downturn would be reduced, making recessions less likely and depressions less severe. Finally, Keynes also argued that the government should engage in what he called counter-cyclical spending. What does this mean? Put simply, it means that the government should be a mirror image of the economic activity in the country. When the economy is robust and growing, the government should reduce its spending and generate a surplus, which it can then use during an economic downturn. And when that downturn occurs, the government should increase its spending, running a deficit where necessary, to ensure that total economic demand remains roughly the same. In doing so, it would ensure that the deepest part of the recessions and depressions are avoided. Collectively, such efforts centering on tax rates and levels of government spending are usually referred to as fiscal policy, which we normally contrast with monetary policy, the purview of central banks that we discuss in a little while. Keynes's ideas became widely accepted in the aftermath of World War II, and Keynesianism became the central theoretical foundation on which the post-World War II economy was built. As we observe in another video, the Great Depression was ultimately brought to a close by the massive increase in government spending and employment sparked by World War II. At the end of the war, the United States, as the world's leading economy and military power, had a keen interest in developing an international economic system that would both result in greater economic activity while simultaneously reducing the likelihood of another global conflict. The system that was established was rooted in Keynesianism and was most often described as a system of embedded liberalism. At the most basic level, embedded liberalism permitted domestic protection and regulation of the national economy, while simultaneously promoting free trade between countries in the international economy. Thus, countries were free to develop labor protections, unemployment schemes, national healthcare systems, and environmental protections, as well as other domestic regulations, but also to export and import goods without fear of high tariffs or other anti-free trade measures. At the global level, several key principles were established and international institutions were set up to ensure a functional global economy. The World Bank, formerly known as the International Bank for Reconstruction and Development, or IDRB, was established to provide concessional loans to countries rebuilding after the war. Following the reconstruction of Europe, the mission of the bank gradually expanded, providing loans to finance development in the global south. The International Monetary Fund, or IMF, was established to provide member states short-term loans when they faced balance of payments problems in order to maintain stability in currency values and broadly to maintain liquidity in the international economy. Together, the World Bank and the International Monetary Fund were referred to as the Bretton Woods institutions because they were formally negotiated at the Bretton Woods Conference in 1944. Finally, the Bretton Woods Conference envisioned an international organization called the International Trade Organization be established to negotiate for liberalization of international trade and to ensure that countries complied with international trade rules. However, the ITO proved problematic and it was never established. In its place, the General Agreement on Tariffs and Trade, or GATT, was established in 1947. And through a series of successive rounds of trade talks, GATT gradually lowered tariff barriers. It was replaced by the World Trade Organization, or WTO, in 1995. More broadly, the post-war system of embedded liberalism rested on a number of key pillars, including a stable and predictable exchange rate between countries' currencies. Under the post-war system, most currencies were pegged to the value of the US dollar and operated within a relatively narrow band of price fluctuation. This was critical to maintaining stable international trade and preventing the competitive devaluation that destabilized the global economy during the Great Depression. After the war, it was no longer possible to back most international currencies with gold, as had been the practice before the war. From a practical standpoint, the United States had the vast majority of the world's gold, thanks in part to transfers from allies during the war to pay for military equipment and material. And from a policy stand, the viability and desirability of gold-backed currencies was being called into question. A reserve asset in the form of the US dollar, a dollar-based economy, as a compromise, reflected the dominance of the United States in the post-Cold War order. The United States would continue to back its currency with gold at a fixed exchange rate of $35 an ounce, and other countries would peg their currency to the US dollar. The US dollar would be the primary reserve asset, and global prices for key commodities like oil would be set in US dollars. Third, strict controls over international capital flows would be imposed by governments in order to limit or prevent currency speculation that had been commonplace in the period leading up to the Great Depression. Fourth, the International Monetary Fund was established to ensure the availability of short-term loans to prevent balance of payments problems. This would, at least in theory, prevent economic and financial crises and ensure governments were able to pay their debts. And finally, a rules-based regime governing international trade was developed in an effort to prevent competitive use of tariffs and the use of non-tariff barriers to gain an unfair trade advantage or to export financial crises, as had been the case in the period leading up to the Great Depression. In more theoretical terms, the Keynesian compromise was rooted in an economic model known as the Phillips curve. In its most basic formulation, the Phillips curve highlights the trade-off between inflation and unemployment. Remember that inflation can be thought of as a general increase in prices, or perhaps more accurately, as a decline in the purchasing power of money. When the inflation rate is high, prices tend to increase quickly and the purchasing power of money declines rapidly. Periods of rapid price inflation, sometimes called hyperinflation, can have a devastating effect on national economies. Think of Zimbabwe in the late 1990s and early 2000s, or Brazil between the mid-1980s and mid-1990s, or Germany during the period of the Weimar Republic just before World War II, when even a wheelbarrow of money was not enough to buy a loaf of bread. Such hyperinflation is most often the case because of sharp declines in the value of money, discouraging savings and encouraging hoarding of commodities, thereby producing a rapid shortage of goods. Why save your money if, in the case of Zimbabwe, tomorrow it will purchase less than half of what it purchases today? In the end, currency becomes totally useless. Instead, people find creative alternative uses for currency. In the Weimar Republic, people burned bundles of marks, the German currency, instead of firewood because it was cheaper to do so. Children also made kites out of marks, and some families used them as wallpaper. And in Zimbabwe, signs like this one became commonplace, asking people not to flush Zim dollars because they were widely used as toilet paper. The second part of the Phillips curve deals with unemployment. Now, we normally think of unemployment or the unemployment rate as the proportion of people who want to work but can't find a job. The Organization for Economic Cooperation and Development defines unemployment as when persons above a specified age, usually 15, are not in paid employment or self-employment and are currently available for work. Now, this is a problematic definition for a number of reasons, and the way that unemployment is calculated in most countries tends to understate the number of people out of work. In the United States, for example, there are actually 6 measures of unemployment, reflecting the complexity of the measure, though in practice we tend to emphasize just one called U3. U3 measures the number of people, or more accurately, the proportion of the labor force, who are currently without jobs and who have actively looked for work in the last 4 weeks. But what about people who have been unemployed for so long, who have been looking for a job for so long, but who have been unable to find one? Eventually, they may give up entirely. These people are usually referred to as discouraged workers, and they're not actively counted as part of the unemployment rate because they've stopped actively looking for work. These people are not included in U3 measures of unemployment. And what about people who would like to work full-time, but who can only find part-time work? Such individuals are usually referred to as underemployed rather than unemployed. But even though they would rather be working full-time and may be actively looking for a full-time job, they're also not counted in the U3 measure of unemployment. The official unemployment rate also excludes a number of other populations, including students who are not considered part of the labor force even if they're looking for work, or other certain groups of people, including non-citizens and people in the correctional or mental health care facilities. When such excluded groups are included in the broadest measure of unemployment in the United States, a measure called U6, the unemployment rate often more than doubles. Now, it's possible to graph the trade-off between inflation and unemployment using the Phillips curve. As shown in the Phillips curve here, we would expect that decreases in the unemployment rate would be met with increases in the rate of inflation, and increases in the rate of unemployment would be met by decreases in the rate of inflation. This trade-off was at the heart of the Keynesian compromise and is reflected in the twin mission of the Federal Reserve Bank in the United States, frequently referred to as the Fed. Established in the early 20th century, the Federal Reserve is an autonomous arm of the federal government. It has a dual mandate of maximizing employment and stabilizing prices, or in other words, of keeping both inflation and unemployment low. To accomplish this twin mission, the Federal Reserve has a couple of very powerful tools on which it relies. Collectively, these tools are usually referred to as monetary policy when they effectively deal with the country's money supply or the amount of money in circulation in the economy at a given moment in time. As we mentioned earlier, monetary policy is usually contrasted with fiscal policy, which focuses on tax rates and government spending. The tools available to the Fed include setting the bank rate and the federal funds rate. The bank rate, sometimes called the discount rate, is the rate of interest charged by the Federal Reserve to banks in the United States to borrow from it. This rate, in turn, effectively sets the federal funds rate, the rate banks charge one another to borrow money, and the federal funds rate, in turn, effectively sets interest rates for most other forms of credit, from building mortgages to auto loans to credit cards in the United States. By decreasing the rate, the Federal Reserve makes it cheaper for banks to borrow money, which in turn makes it cheaper for consumers and businesses to borrow money, thus encouraging investment and economic growth and, in theory, reducing the rate of unemployment. But such moves can be inflationary. Conversely, by increasing the rate, the Federal Reserve makes it more expensive for banks to borrow money, which in turn makes it more expensive for consumers and businesses to borrow money, thus dissuading economic growth. Such a move may cut inflation, but slowing economic growth also means accepting a higher rate of unemployment. The other tool available to the Federal Reserve is managing the country's money supply. It can do this through open market operations, which is when the Fed buys or sells treasury bills or other securities. Buying treasuries injects money into the economy. Selling treasuries does the opposite, withdrawing money from the economy. It can also influence the yields on securities in an effort to set the interest rates in the country. The Fed can also increase or decrease reserve requirements for banks. Put simply, the Federal Reserve requires that all banks in the United States maintain a certain percentage of their deposits as cash on hand, normally somewhere between 3 and 10%. Banks are free to loan the remainder out and routinely do and charge interest, generating a profit. By increasing the reserve requirement, the Fed forces banks to keep more cash on hand, reducing the amount of money they have available for loans and thereby reducing the total money supply in the economy. Conversely, by reducing the reserve requirement, the Fed permits banks to loan more money out, effectively increasing the total supply of money in the economy. Now, most other countries have similar systems with a national institution responsible for managing the country's money supply. These are often referred to as central banks, but they have similar mandates and powers to the U.S. Federal Reserve. The United Kingdom has the Bank of England, India has the Reserve Bank of India, Japan has the Bank of Japan, and so on. And the European Union has the European Central Bank, or ECB, which is responsible for managing the economy of the entire Eurozone. As we'll discuss when we look at the European Union, the ECB interestingly does not have responsibility for unemployment, only inflation. This, combined with differences in the economies of many European Union member states, has created unique challenges for the ECB, which we consider elsewhere. Between the monetary policies of the Federal Reserve and the fiscal policies adopted by the U.S. government, the Keynesian compromise worked pretty effectively for much of the immediate post-war period. From 1945 through the 1960s, economies around the world were growing and standards of living were improving. Through the 1960s, unemployment gradually decreased and the rate of inflation increased as the Phillips curve suggests it should. In 1960, the U3 unemployment rate was about 6% and the rate of inflation was about 1.4%. By 1969, the unemployment rate had increased to 3.5%, and the inflation rate, measured by the CPI, or the Consumer Price Index, had increased to about 6.2%, but both remain within bounds deemed acceptable by policymakers. But in the 1970s, the Phillips curve began to break down. Contrary to the model's prescription, inflation and unemployment both began to rise at the same time. In 1974, the U3 rate of unemployment had increased to 7.2%, and the inflation rate was hovering at about 12.3%. Traditional Keynesian tools were proving ineffective, and the Fed was failing at its twin mission of keeping inflation and unemployment in check. The United States and other leading economies around the world had entered a period often described as stagflation. Stagflation, the combination of economic stagnation and correspondingly high rates of unemployment and high rates of inflation, presented a conundrum for policymakers. Remember that economic policymakers made decisions based on the model that suggested this couldn't happen, that inflation and unemployment were inversely related, and that when one went up, the other necessarily went down. The tools to them presented no clear avenue forward. They could not bring unemployment down without risking an increase to already high rates of inflation, potentially sparking hyperinflation, and they could not bring down the rate of inflation without increasing an already unacceptable high rate of unemployment. So what did they do? How did they address the crisis of stagflation in the late 1970s? We deal with that in our video on neoliberalism. Thanks for watching, everyone. Bye.